Hello and welcome to another fresh episode of Africa Business Weekly as we throw the spotlight on some of the biggest conversations that shape the world of business across sub-Saharan Africa this week. I'm David Alabi. Now, a major focus this week is on African central banks' moves as they hold their first meeting of the year. From our West African desk, Tilewa Adebajo, the Chief Executive Officer of CFG Advisory, and Mustafa Chikobi, Chair of the Bank Directors Association of Nigeria, share insights on how to achieve the right balance between monetary and fiscal policy measures to resolve high interest rate to deposit spreads. And crossing over now to East Africa, we'll also explore opportunities in Rwanda's agriculture and food processing market. The Executive Director of Invade Group, Kamlesh Chotalia, walks us through how the brand is positioning going forward. Well, let's get right into today's conversations. And we have Karabo on standby for the regional updates from South Africa. Hello, Karabo.
Thank you, David. Well, Chinese startup DeepSeek has recently made headlines and topped app charts with its new AI chatbot, leading to a worldwide tech sell-off that erased billions from Silicon Valley's largest firms and challenged America's supremacy in the tech competition. To discuss the implications for tech giants globally, CNBC Africa's Nastasia Aronsa spoke to Neil Wilson, who is an analyst at TipRanks. Let's listen in.
There's probably a couple of main things that we saw yesterday. One was the sort of capitulation of some of the hot money that's come in. So you kind of had this, if you're playing poker and you go all in, you'd had that kind of Stargate announcement from President Trump. You'd seen a lot of sort of hot money, hot flows of money coming into some of the AI names, and particularly NVIDIA, of course, which has been the main sort of picks and shovel kind of play on AI spending. You'd had Microsoft talking up $80 billion of investment in AI this year. Meta talking up 60 billion to 65 billion. So you'd seen a lot of retail money coming in. And then yesterday, there was a bit of a capitulation there. I think if you look at some of the sell side notes that we've been passing here at TipRanks, and there's not been a massive kind of knee jerk from the analysts. They're a bit more sanguine about the impact of DeepSeek. I think that there's maybe been an overreaction in the market. That's not to say that the model that DeepSeek has produced is not important. It doesn't help to sort of commoditize some of that AI space. But I think there's maybe been an overread of some of the figures, particularly around the costs involved. So the $5 million cost to develop the R1 model, for example, that seems to have been latched onto. Quite a few of the analysts that we look at have been pointing out that that's probably not entirely genuine. So there are several things going on, but I think one of the main things is just simply the market had been riding pretty high. It was looking a bit bubblish, and this was the kind of news the sort of news that can change the assumptions.
So is that why we're calling your note for DeepSeek the Emperor's New Clothes? Take me through this title name.
Yeah, so there's the famous Warren Buffett quote about it's only when the tide goes out that you see who's swimming naked. So it's a play on that, I guess, but it's that idea that it's the second order or third order effects of this move. So what we don't know right now is what sort of leverage positioning was at play that was being unwound when the selling took place, because the severity of the moves in some individual stock names, particularly NVIDIA, Oracle, and some of the energy companies that have a direct exposure to AI, they were quite significant moves, and we think that maybe there's potential for second order effects from that as traders deleverage. But the question really on a fundamental basis for investors is really more, does DeepSeek, does it commoditize the space a lot more? Does it upend the assumptions? Does it change AI from being prohibitively expensive where only Microsoft and Meta and Google can really do it, or does it bring it into more of a mainstream kind of space? So, interesting point yesterday that we noted was that there were more advancers than decliners on the New York Stock Exchange, despite all the selling pressure that was taking place. So, there might actually be more winners than losers from this development.
And driving it back home, South Africa's Reserve Bank held its first monetary policy committee meeting for the year on Thursday. The interest rate cut cycle is expected to slow this year after 2 cuts in quick succession at the end of last year. To unpack the governor's remarks and implications for the South African economy, our senior anchor Fifi Peters spoke to Patrick Buthelezi, who is an economist at Sanlam Investments, as well as Vishal Rama, quantitative analyst at Prescient Investment Management. Let's listen in.
As you say, a lot of noise going into this MPC meeting. However, we've seen a very muted reaction from the bond market, right? Same for the currency market, as you say, right? It's fairly flat. It speaks to how this cut was already priced into the market. We saw, if we looked at the FRA curve going into the meeting, 25 bips was priced in, hence muted reaction from the market. I think it's important now to see how the market reacts to the communication that the SARB put through in terms of, the tone from the governor was fairly hawkish. So, yeah, we'll wait to see how that now translates in the market, and we'll see how US data comes out tomorrow and take from there.
Sure. There's a lot of digesting, I'm sure, still taking place within the various trade rooms and investment halls. Patrick, give us your take here. As Vishal said, a muted reaction in terms of the currency. It was expected, but perhaps what wasn't expected, particularly from my layman point of view, was the division in terms of this decision. I mean, you had 2 MPC members saying that actually rates should have stayed as they are right now, notwithstanding the fact that we have seen inflation coming through, and notwithstanding the fact that some argue that this economy locally could do with a whole lot more stimulus. But your key takeaways from what the MPC did deliver today, and what stood out for you?
No, I think for me, what you were just mentioning was very interesting, the division. Looking at the numbers, for instance, the statement for me sounded a little bit hawkish, but if you're looking at the numbers, for instance, inflation forecast and including economic growth forecast, those numbers didn't change much from last time. So you still have inflation this year just below 4%. Next year, inflation was kept at 4.6%, and then year after it's around 4.5%. So the focus is still more or less the same. But the tone of the statement was relatively hawkish. I think what may have influenced even the other 2 members who voted for a hold, I think, is what happened in the US, which is also reflected by the scenarios they performed looking at the impact of trade wars. I think we are in an environment of heightened level of uncertainty. So I think for central banks, they want to take it as easy and be more cautious about how they approach this cycle. But what was interesting was that the governor indicated that the policy stance is still restrictive, so which means there's still a little bit of a room, but the scope is very limited. You also indicated that even in the US, the scope for cutting rates is limited. So I think we are getting close to the bottom now.
And that wraps up our weekly update of news driving the Southern African region. It's back to you, David.
Thanks for the updates there, Karabo. Now, up next, we cross over to East Africa for more content. Over to you, Thabita.
Thank you, David. East Africa this week had a mix of developments, including more businesses coming into Rwanda. Taking it away, health expert Nurse Born from Population Services International and the Elizabeth Glaser Pediatric AIDS Foundation is redefining global health amid shrinking fund. I spoke with CEO Carl Hoffman, who highlights the role of international non-governmental organizations, urging them to adapt African governments to lead funding efforts and also health systems to strengthen. Here is that exclusive interview.
HealthX Partners, which is a co-creation of 2 long-standing international NGOs working in Africa and elsewhere around the world on global health issues. That's EGPAF, the Elizabeth Glaser Pediatric AIDS Foundation, and PSI, Population Services International. EGPAF and PSI have come together to create this new structure, HealthX Partners, as a way to get deeper value from their work, more efficiency in their work, and attract other organizations into this model. And we think it'll be an important innovation in the global health landscape.
And in terms of the value proposition, what are we seeing here, Carl, and also looking at the business model? Why do you believe or think it's going to work?
Right, the value proposition, I think, fundamentally consists of two things. Both PSI and EGPAF have long experience, as I said, in many countries in Africa, and in the case of PSI, outside Africa as well, and EGPAF has a history working outside Africa as well. We work in global health, but we work in slightly different ways, these two organizations. We think the opportunity of coming together under HealthX Partners is going to allow for a broader perspective on how to deliver greater value and greater health impact to the people we're trying to serve, to health ministries, and to the people who fund us. After all, none of the individuals we're working for in any country where any of these organizations works has a narrow set of problems or challenges. Everyone has a complex, let's call them horizontal set of challenges. And we think the HealthX Partners model is going to allow our foundational organizations, PSI and EGPAF, to look more broadly and think more holistically about how to program effectively for the people we're trying to serve. Also, we know that by coming together under this parent company structure, we can be more efficient and more effective in terms of how we deliver those services. Look, every organization has to have support functions, infrastructure functions, the kinds of things that are often referred to as overhead functions. By bringing some of those together in the HealthX Partners context, we can lower the cost and put more resources toward actual health impact and less resources toward managing the business. So it's an innovation in the business model. I think it's an innovation programmatically as well. And we're hopeful that it's going to be compelling, not just for the success of these two organizations, but for other organizations that might join us in the future.
And now, switching gears, day one executive order by Trump. Trump is in office, and the first thing that he says is that he's halting foreign aid. So what likely potential are we likely to see in terms of the implications for the global health sector, especially the impact on US-funded global health projects in Africa?
Right. Trump was very busy on day one,
yes.
Issuing lots of so-called executive orders with lots of change inherent in them. And I think the message is clear that he intends to be a disruptive presence in a lot of areas that we have all taken for granted. I think the message is really clear that all those who work with and depend on the United States in terms of the kind of work that organizations like mine do have to think differently about how this work should be done going forward. You know, his approach is a very so-called America First approach, which I think has the risk of becoming an America alone approach. And I don't think that's going to be successful for long-term health and prosperity and well-being of everyone in the world. But it's clear that that is the early intent of the Trump administration. So things like withdrawing from the World Health Organization, which I think is going to make it more difficult for all of us to fight the next pandemic, and also is going to create a vacuum where U.S. leadership has been important in global health. Other actors will be drawn in, and other pressures will come on, particularly on host governments, countries in Africa who may be expected to step up for more of the cost of these global health programs that save lives. I think in this troubled landscape, the worst thing for any organization like mine, like the HealthX Partners Group, to do is nothing. The worst thing to do is nothing, because the message is clear that there's an expectation of change in the sector. And so our approach, this HealthX Partners approach, is part of our response to that. We want to think about a more effective and efficient way to deliver our services. We want to be more holistic. We think the message is times are changing in the global health landscape, and we better be ready for it.
Shifting gears, Invade Group, with an annual revenue of about $400 million is expanding into the Rwandan market, targeting agriculture, farming, and food processing niches with a focus on premium exports. The group is also preparing for a significant market move with plans to list on the Indian National Stock Exchange and the Bombay Stock Exchange in September 2025, projecting an $8 billion market capitalization. I spoke with Executive Director Kamlesh Chotalia about the group's strategies and future plans.
It's surprising when we say Rwanda as our global headquarters. I will put it in short that Rwanda is centrally located within the East African region and the SADC region. Now, Rwanda scores very high within the East African community for doing business, providing conducive business environment with reference to good governance. The second is the development of the infrastructure, the roads, the communications, the upcoming international airport, and the political stability provided by the government. And when it comes to business, the ease of doing business and the time frame set by the government, it is the best within the East African community. Among all the countries, we are talking of Kenya, Uganda, Tanzania, Burundi, Zambia, Congo. So overall, when we look at Rwanda, Rwanda is upcoming within 5 years. Down the line, what we are looking into is it will be the centrally well developed country, at least within the sub-Saharan African region.
Yes, Kamlesh, Rwanda is already developed in terms of its agriculture. So in terms of its agricultural transformation, there's quite a lot we're seeing here. And I understand, or rather the big question is, what do you bring to the table? So let us understand, help us understand what kind of partnerships or collaborations that you foresee with local stakeholders, including the government and also other private enterprises.
Now, our Invade Agro is specifically focused on the agriculture sector. Now, within agriculture, there are 4 verticals. The first vertical is the farming and the plantations. The second vertical is the agro inputs. The third vertical we are talking of is the commodity trading. And the fourth vertical is the food processing. Now, out of those 4 verticals, presently, Invade Agro is present in 3 verticals with the revenue of close to $400 million plus per annum. Now, when it comes to Rwanda, what we are looking into Rwanda is that we are looking for a premium or a niche produce to be exported. So all the what we call overall, when we put it as a plantation, what we want to do is that contract farming with the local farmers with reference to maize, sorghum, cassava, and to increase their productivity in relation to same. Now, when it comes to agro inputs, it gets quite interesting because right now we have a leadership position in Indian subcontinent and in Tanzania with reference to the branches, the supply chain management.
That's all from me now. It's back to you.
Thanks a lot, Tabitha. Now we bring our regional focus back to West Africa. Resolving the high interest rate to deposit spread in Nigeria requires a coordinated and balanced approach that involves both monetary and fiscal policy measures. Well, that's the joint stance of Tilewa Adebayo, Chief Executive Officer of CFG Advisory, and Mustafa Chikobi, Chair of the Bank Directors Association of Nigeria, in a new report. They say a release of 20 to 25% TRR funds to be directed to lend into the critical real sectors of the economy at an interest rate of not more than 20%, among other recommendations, will reduce the average lending rates.
The interest rate spreads defined is just the difference between where banks pay, what banks pay for deposits and what banks lend at. That rate represents a whole bunch of things for banks. It represents the economic environment, it represents statutory requirements, it requires so anything that happens to a bank that's adverse is reflected in the spread widening, and everything happens to the banks that's good for the banks, the spread narrows. But when I say good for the banks, I mean what's good for the banks is, we have found, is correlated with what's good for the economy. So when the spread is very narrow, the economy does better, and when the spread is very wide, the economy does worse. And if you look at all the countries in the world that have good economies, significant economies, the spread is extremely narrow. And Nigeria is the highest spread that we looked at in the world.
Yeah, let me get the economist's viewpoint here, because now we're talking about the spread here and the impact on the economy. Tilawa, from what you sit, looking at an output standpoint, help us appreciate what's playing out there.
Well, we looked at Nigerian banks against the African banks and also G20 banks over the last 15 years. And we find out that consistently over the last 15 years, Nigerian banks' interest rate spreads have been higher than all their contemporaries. So that reflects an intrinsic structural problem within the Nigerian economy, and that is impacting not only on the banks, that pushes them to increase their spreads, but is also impacting GDP. And when we did the correlation between interest rate spreads and annual GDP growth rates, we found that there was an inverse correlation. When interest rate spreads are lower, we experience higher growth rates, also in the last 15 years in Nigeria. And when interest rate spreads are higher in Nigeria, we experience low GDP growth rate. So that correlation is significant. So that's the findings that we've seen.
Yeah, it's good to paint the picture here, because then I'd like to get to the root causes, because yes, it's not a problem that is existing all of itself. And I'm looking at your report here. You list 4 key causes here. You talk about the regulatory requirements, charges and taxes. You talk about the monetary policy stance. You talk about liquidity and funding, and also the high credit risk. Would you say that's an increasing order of importance or decreasing order of importance, sir?
Yes, the most important is the CRR.
Okay.
Very simply, if CRR was 100%, there's no banking, there's no lending, there's no deposit taking. So it's the spread. The spread will be 100. If CRR was 0, the spread will be narrower, because now we can pay more for deposits and we have more money to lend, and we can charge less for lending. So that's the biggest impact by far is CRR. Now, just to be clear, we're not calling for CRR to be reduced or increased. That's a policy thing for CBN to decide in the context of monetary policy. But we're saying that a high CRR will lead to a high spread, and a high spread will lead to a slower economy. So CBN has to consciously make the choice to keep CRR at these levels, because the drag on the economy is significant.
Let me get your thoughts on this as well, on the causes here, because we're looking at these 4 key areas which you've listed here. And monetary policy is one which we've discussed many times here on the channel here. Again. And we understand that the underlying factor there is inflation, and what the central bank is doing. Growth and inflation, where the central bank is trying to find a balance.
Yes, again, there's cause and effect. And the CRR that you've mentioned, at 50%, is the highest in the world in Nigeria. The next to that is Turkey, which is 25%, and Brazil is about 21%. You have other countries like China and Malaysia as low as 2, 3, 4%. So these are extremely challenging times. So basically, the indication of a 50% CRR shows that you have some significant challenges within your economy. And that is why the monetary authorities are reacting in that manner.
And next up now, the global head of insurance at Texel Group, Simon Besson, says deeper collaboration between development finance institutions, insurance companies, export credit agencies and the public sector are key to scale capital mobilization and infrastructure financing on the continent. He shares his views on the role of insurers in mitigating risks, the change in economic landscape and strategies to leverage institutional investors. Have a look.
I think initially it's important to consider, when looking at institutional investors, why there is potentially at the moment a gap, and an ever-growing gap, of infrastructure funding on the continent. I think we can boil it down to one word, which is probably risk. It's often that the risk itself is apportioned potentially to the wrong parties. You look at the private credit market, which is continuing to grow, exponentially, certainly on the Western hemispheres, and there's a sort of a disconnect between the growth of that private credit world and the volume of private credit or institutional investment into the African continent. in that, my opinion there, or the opinion certainly of me and my peers, is that there's a gap here in who needs to be taking the risk. And when you look at the risk within Africa, and generally the word risk, the best place to locate such risk is with insurance companies and their balance sheets. Insurance companies are set up and able to price risk and assume risk with their capital stack in a fashion that allows risks to be distributed correctly into the financial services and financial industry. So where we, I think, need to continue to create a bridge here is a bridge between the insurance market, who is capable of taking risk, and the institutional investor market, who is looking to find and put funding in place towards stable, strong cash flows from infrastructure transactions that can certainly be found on the African continent. And the role here that the Texel Group and the wider London insurance market has is to create insurance products that can satisfy the needs of an institutional investor from a risk transfer perspective, and can then be utilized to bring such long-term, one would suggest, economically viable and sustainable funding sources onto the African continent. And that's where I think we can add value here into this process to create those structures and to work to harmonize and bring together the insurance market and the institutional investor market.
Sure, and I like the fact that you've also touched a little bit towards how we also see the scaling up of transfer of risks embedded in when we look at loan portfolios, especially to the private sector. But at this moment now, when we are looking at key markets here under the radar, South Africa, Nigeria, Kenya, in terms of shifts that you expect this year, what's your forecast like? And still going around the element or the concept around risk perception, the bankability of our projects, the preparedness so far. What's your overview? Using 2024 as an example, the sort of deals we were able to close, the milestones we were able to record, the mobilization strategy, and how should that define what we should expect this year?
It's entirely possible to look country by country and provide an insurance market's view on the risk and the sort of the credit risk of each of those countries from a sovereign and potentially a project-specific requirement. But actually, I think it's probably more relevant if we can initially look at how can lending be increased into Nigeria, into Kenya, into South Africa, into other parts of the continent where infrastructure development is required. And I think that is through the collaboration and continuing that collaboration between the development finance institutions, the multilateral development banks, and the insurance market.
And on that note, it's a wrap on this week's show. Many thanks, Karabo and Tabitha, for the regional updates. And thank you, too, for your company on the show. Do join us again same time next week as we bring you more conversations. I'm David Alabi. Enjoy your weekend.